Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. We're going to be talking about a specific subset within the MF space today, and that's ETFs, and kind of do it in a two-pronged way because there is a new ETF in the offing as well from the house of Mirae. So Siddharth Srivastava, head of the ETF products and fund manager at Mirae Asset, joins in to talk about that offering and the group and the space at large, as does Arnav Pandya, founder of Money Edu School. Gentlemen, both of you, thanks so much for taking the time out. Really good having you. Arnav, it's been a while. Good seeing you on air. But I'll start this show with Siddharth. We know that ETFs turn out well from a perspective of costing, etc. What's the basic argument for ETFs in India vis-a-vis the non-ETF side of the mutual fund end?
I think now we are having a good track record, which just highlights that active mutual funds struggle to outperform the benchmark on a consistent basis. We may see some active funds doing well year one, year two, and then underperforming, whereas ETF just removes that active fund manager risk, comes at a low cost, is transparent, and you know what is happening in the portfolio itself. And that is why we are seeing that first the ETF adoption started for large caps, then it moved on to mid caps, and now you are seeing good amount of ETF appetite for smart beta funds and even for thematic funds.
Okay, and what's the, I mean, in general, so yeah, okay, let me first take the question to Arnav. Arnav, what is your view on this whole, if I can use the term in a positive way, proliferation of ETFs and passive products, if you will, and if on an average, Arnav, if you were to build out a portfolio, average risk appetite, average duration, average appetite, like I said, for risk, what is the quantum of passive / ETF products would you recommend in a portfolio?
So first thing, in terms of the proliferation of all these ETFs and other passive products which you see there is also an industry angle to it, which is that the SEBI regulations say that within the active category, every fund house can have only one product. So that by itself limits the number of products which a fund house can launch within the main categories. Obviously, in the thematic category and the other such areas, you can have a lot of products. But here, when you come to the passive space, you have a lot of room to innovate, because investors who already have plain well enough funds in their portfolio, who have built up the core of their portfolio, they can move on to many of these passive products, which give them a slightly different flavor or exactly what that portfolio needs. So that is the thing in terms of the overall large number of funds which you are seeing. And you can see investor interest in all these kind of funds. Now, if you look at the portfolio of an investor, at the moment, every investor, according to me, should have a mix of these active and passive funds. And for me, there are a few categories like the large caps where there is a compelling reason for the inclusion of such funds. But overall, I mean, for, as you said, for a individual, the situation will change according to each of their needs and all. But I would say that not more than 15 to 20% of their portfolio would go into these kind of different kinds of passive products as of now. But as the field grows, the scope will also grow. But one more thing I also want to point out, one should not just look at the equity space, because according to me, in the debt space, there is a room, or rather I would say there is a large scope for having a bigger part of the portfolio in these kind of passive products.
Mm-hmm. Okay. Okay, interesting. Well, Arnav, you want to very quickly expand on that point that you made?
Yes. So, for example, in the debt space, one of the big problems that a lot of investors have is planning for the long term, and which is where now you have these kind of target maturity funds, where they are actually, many of them are, you can have them based on the particular index, so that you are getting a diversified debt portfolio, plus it removes a lot of the risk which normal debt investors would face over the time period, and it's actually ensuring that you can plan for the longer term in a better way.
Okay, Siddharth, you agree with that?
I think it's high time that we see passive options on the multi-asset side and all the debt side also. In fact, very interestingly, now we are seeing that for target maturities, certain AMCs have filed for sector-specific target maturity funds focusing on just NBFCs and HFCs. So we are seeing innovation happening on debt side also now, and I hopefully SEBI will allow multi-asset category to also come up on the passive side. They have floated a consultation paper around it. So I think like gentleman mentioned that passive, apart from the core strategies like Nifty 50, Sensex, you can come out with a lot of innovative products which either sits well in an investor's core portfolio or a satellite portfolio.
Now, Siddharth, my question, I mean, because you guys have this Mirae Asset Nifty 500 multi-cap 50, 25, 25 ETF, right? Almost everybody that we've spoken to last few years have said that, yes, the SPIVA scorecard shows that large caps have not managed to beat, mid caps and small caps have. In a multi-cap, there is 50% exposure to mid caps and small caps.
Correct.
Why should I choose a passive route wherein the active fund manager has a very high probability of actually beating the index?
In fact, you'll be surprised to know that in last 1 year or so,
1 year, okay.
yeah, large cap funds have in fact outperformed the benchmark, and mid cap funds have struggled to outperform the 150 benchmark index. So it's no more a large cap phenomena. You see underperformance happening even on the mid cap side. And I think this multi-cap idea is a very simple idea which can form part of any investor core portfolio. You know that through this product, via this investment in this index portfolio, you're getting 50 large cap and 25 mid cap and 25 small cap. So it's simple, it's logical, and in terms of asset allocation within equity, it makes a lot of sense.
You're effectively telling investors that if you want a large cap exposure, but at the same time want mid caps and small caps as well, and because let's say if there was a flexi cap ETF that need not be so correctly defined as 50, 25, 25, the multi-cap ETF does that trick for you.
Absolutely. If you look at Nifty 500, for example, which is a benchmark for a lot of flexi cap funds, 72% is large cap, 18% is mid cap, and 10% small cap. If you look in last 1-2 years, it's very difficult to say whether large cap will do well or a mid cap will do well or a small cap will do well. It's better to invest in a very sort of rule-based manner, some portion in large cap, and then a reasonable allocation in mid cap and small cap also.
Okay. Now, Arnav, what is your view here? And your view could be not to subscribe, by the way, because we should give that liberty to both experts to talk about the other end that way. The only difference, Arnav, that I usually hear people come and tell me, advisors come and tell me that, you know, NFOs, let's leave them out, let them perform for 6 months, 12 months, and then we'll take a call because there are enough funds available. In the case of an exchange-traded fund, the performance metric or yardstick is, that conversation is nullified, if you will. What's the relevance of a product like this, Arnav, to your mind in an investor portfolio?
So the relevance of this kind of product is that, see, in the mid and small cap space, specifically the small cap space, it's very difficult to choose a fund which can actually give you, or rather hit the mark in terms of performance, because there is such a wide choice which is available. What you are doing through a product like this is having all of the holdings in a particular investment without having to take a risk on the fund manager. So people who are not comfortable, or rather who are not able to choose a fund manager, because see, performance varies and there are different ways in which a individual can choose a fund and stick to a fund manager and all that. For them, this is a product. So for me, if you look at, if there is an existing investor who already has exposure to these kind of things, many already have an exposure to multi-cap funds, for them, there is no need for such a product. But if there are investors who have a problem in choosing which fund to invest in, for them, this solves the problem. And that is what a lot of passive products do. They take that question of making a choice out of the hands of the investor, which often makes the job of investing easy.
Okay. Siddharth, final word to you. We have about 60 seconds. What's the expected return based on what these index has done in the past? On an average, what do you think an investor in such a ETF would get?
I think first of all, it's difficult to predict the returns.
Of course. But based on past history.
But I think our view is that from a nearest 3 to 5 year point of view, market will roughly be around 13 to 15%. That's a broad benchmark Nifty we are talking about. So I think a bit more kicker on that is something which multi-cap allocation should provide, but that these valuation investors should come from a 5-year mindset, because I think a lot of returns have already happened. So allocation should happen at least from a 5-year point of view.
Okay, and maybe viewers, a SIP approach might not be bad in a product like this, because you don't know how multi-cap as a space would do in the next 6 months because of the valuations of the mid-cap and the small-cap end. So you might want to maybe take it a SIP product as well. Arnav has said that there's relevance here, so they're talking about the kind of returns. Gentlemen, both of you, thank you so much for taking the time out and speaking to us on this leg of the mutual fund show. We have to wrap it up on the MF show, but stay tuned, because a conversation with a management whose stock is very hot in the recent past is coming up next. Stay tuned.